What's up, noobs? I know it's been a minute since I posted, but I am actually recovering from COVID, so I have not been able to script, film, or produce anything in the last couple weeks. But I am getting a little bit restless since I haven't posted anything in 2 weeks, so with this video, I'm going to try something a little bit new. We're going to go through the top real estate headlines together. So starting with national news, this is a little bit of a clickbaity article, but as you may know by now, the Fed has increased the funds rate by 75 basis points, and mortgages as a result, and as you can see in this headline, are flirting with 6%. Now, the clickbait here is, but silver linings exist. Now, I went ahead and already read this article, so skipping to the juicy part, the headline basically is that 6% interest on a home loan is quite reasonable, because back in the 80s, interest rates reached 18%. Now, it is a huge shock to buyers, especially first-time buyers, because we've been accustomed to interest rates below 3% for the last few years. So purchasing power is way down right now, and 6% is just a huge shock. So regardless whether this happened in the 80s or not, and even pre-2008, the interest rates were around 6%. This still presents a huge challenge for the buyers that are out there because there's still record low inventory. So that brings me to the next article, and a topic I've been covering in depth lately in my previous two videos, and it's about investor and institutional home buying. And they're still going strong. Institutional home buyers are still making up 20% of all sales in 40 of the country's major markets. So that's 1 in 5 homes. If you recall from one of my other videos, I pointed out that in the very top markets, some of these institutional buyers are making up 1 in 3 home purchases. So they are still making a big impact on the markets out there. They still play by a different set of rules from your average home buyer because they have ridiculously cheap interest rates. So it's still causing problems out there. And as a result, we are slowly becoming a renter's nation. Going further down this article, you'll see that they bought 78,000 homes in the first quarter. They have been averaging about 80,000 homes a quarter in the last few quarters, so they're holding steady. Interestingly enough, they are shifting their buying tactics to a different segment of the market. Instead of purchasing as many high and mid-priced homes, which they were starting to do a little bit more of towards the end of last year, they've retreated to more low-priced homes. And switching over to local news in New York City, because this is where I operate, we've been seeing some pretty crazy things in the rental market here, and the median rents in Manhattan are now approaching $4,000. Their number one reason is household formation. So a household actually makes a bid on an apartment, not an individual. So a household could be a group of roommates, it could be a family of 4. So they're saying that there's actually more households out there, so there's a greater number of bidders for the same number of apartments. The second reason they cite is that New Yorkers are upsizing their apartments because they're working from home, so they need that office nook. Pied-à-terres are becoming increasingly popular. There's still a lot of vacancies out there, by their count 10%, but it's more on the luxury side. But the bottom line is people are coming back to New York. Always been a lot of things to do here. It's always been a center of jobs. So never count New York out. It's making a huge comeback. On top of that, there were a lot of COVID deals that people took advantage of during 2020. All those concessions are expiring now. So when you see those stats that say that New York is up year over year, 20, 30, 40%, keep in mind, we're going back to normal pre-pandemic. There was a massive amount of concessions given out, and the rents did drop 20 to 40% in the first place. So we're just recovering. All right, and in other New York news, we do have a new mayor, and he recently announced his new plan to fix New York City's growing housing crisis. His plan is actually pretty short on numbers because he knows that news outlets will tear him a new one if he promises numbers and misses them. He's being a little bit strategic about that. Keep in mind the New York Times is becoming an increasingly liberal outlet. They are very pro-rent stabilization, so of course they're highlighting it's $1 billion short of what he promised. It's not enough. But if you look at this quote over here, the mayor's office's rebuttal to that is that if you adjust for inflation, there might have been a year in the early 90s that rivaled the housing budget that they're proposing. So they're taking a seriously good crack at tackling this. When we look at this, we're talking about $22 billion to address homelessness and affordable housing over the next 10 years. And the big conversation that's going on right now is that rents are spiking. It is becoming increasingly difficult to afford an apartment here. It's not for everybody, and especially the long-term New Yorkers, they're getting squeezed out, and it is very difficult to still be a renter in an environment where you're hitting all-time high rents every single month. So yes, it is a real problem, and unfortunately for developers like me, I think this will actually lead to more regulation in the future. I do have quite a bit to say about rent regulation, rent stabilization, rent control, and I have very strong opinions about the good cause eviction bill that just failed. As a developer, I'm very wary about the possibility of much more restrictive policies going forward. That's going to make my job incredibly difficult, to the point where investing and developing in New York is probably not going to be worth it. But again, that's for a future video. Now moving on to the next article. This is currently front page on The Real Deal in New York. Tech layoffs have been making lots of headlines, and Proptech companies are no exception. So Compass is now worth less than it raised from investors. You may be familiar, Compass was one of the big SoftBank real estate plays back in the day. And this just goes to show you that despite the other headline we saw that institutional home buying is still holding strong, the rise in interest rates is definitely affecting the market, and Compass is not the only one. We'll see in the next article. Redfin is also doing a series of layoffs because there's just not that much supply, and now with interest rates rising and buying power decreasing, buyers are also drying up. So agents have less to do right now, and there's just way too many agents out there for the amount of transactions that can happen. And I've always found that the number of active real estate licenses out at any given time tends to be a leading indicator on a real estate market. Because in a hot market, a lot of people want to become real estate agents. And then when it hits critical mass of active licenses, that's typically right before a major real estate crash happens. Because everyone loves to get on the gravy train when they see their friends making commissions selling houses. There's a relatively low barrier to entry to get your real estate license and go ahead and get started. So as a result, when the market gets crowded, it actually becomes super difficult to make a living being a real estate agent because there's just not enough transactions to go around. But anyway, going back to the article, Compass did raise $2 billion in total, and now, as of today, their share price is just hovering over $4 a share. They did go public a while back. Let me show you their chart. And yeah, they've hit an all-time low, and their market cap is just under $1.75 billion. So those initial investors, if they didn't cash out at the IPO, they've lost some serious dough. Anyway, they're not the only ones making headlines. Both Redfin and Compass cut a significant amount of their staff, just like a lot of other technology companies are doing right now. And the prevailing narrative is that these companies are hunkering down for a recession. I personally believe we are headed for a recession. I do like to see their fiscal responsibility right now and doing these preemptive layoffs. However, on the other side of the coin, it's actually not that preemptive, especially in real estate. They're definitely seeing some signals for a pullback, negative growth, all the signs of recession. So that's why I strongly believe we're headed for one if we're not already in one. So brace yourselves for the worst in the coming months. So yeah, these are pretty huge numbers. Redfin employed 6,500 people, Compass employed 4,800 people, and they both shed about 10% of their workforce. In other Proptech news, the layoffs aren't limited to technology-based brokerage companies. Sonder, which is a short-term rental company, is laying off a massive 21% of its staff. And they said they remain optimistic and confident about the future of travel. I also feel like despite a recession, travel will make a comeback because hotel occupancy is still recovering from its lows and there's just a lot of pent-up travel demand. However, Sander's saying it's prioritizing increasing its cash flow and opening units on which it already exchanged contracts in countries where it has existing presence. So they're just focusing on what they have and scaling back on the growth a little bit. It's just a further indication that these tech companies see that we're already in or headed towards a negative growth environment, so they are shifting focus from growth-oriented activities. So these companies doing layoffs, while it is making a lot of bad headlines, it is the prudent thing for them to do. Elsewhere in Proptech, iBuyers are showing signs that the market is also pulling back. According to a Zillow report, iBuyers' total market share of sales in the first quarter dropped to 1.3%, down from 1.7% in the fourth quarter and 1.9% in Q3 2021. Why is this important? It goes back to what's going on in the national single-family home market. There just isn't enough inventory out there, and on top of that, the sudden increase in interest rates really pumped the brakes on the market. And finally, just one quickie headline I want to share about my alma mater, Cornell. They received a $30 million investment into its real estate program, and I am a pretty big fan of the Baker program in real estate. Just wanted to share that little tidbit. I'm happy to see that there's major investment in the school and developing one of the better MESRED programs out there and educating the future of real estate. So go Big Red. All right, hope you guys are all surviving out there. It is a tough market. Stay safe and stay curious, noobs.